Hi, welcome to the Trade of the Day for the 29th of October. My name's Tom. I'm a senior trading analyst here at Trend Signal. We've been teaching people to trade intraday markets since 2003. I'd like to show you an opportunity that we took yesterday in the early afternoon and invite you to come along to the live trading room we'll be hosting at 7 o'clock. We'll talk a bit more about that towards the end of the session. But to show you this trade that we took, to give you a flavor of what we do in those sessions, we need to describe the five-step process for identifying trades as part of the intraday system that we use. How this starts, the black arrows indicate a trade. When it hits a black arrow, it will flip to the other side, indicating that we can start looking for a new opportunity. It doesn't mean that there's one that's particularly worth taking. We have to use the other steps to see if that's the case. So we get an arrow flip. We actually get a weird case here where the arrow flips twice because there's so much volatility around this 1334 candle. But either way, it results in us having a short trade developing. The first thing we need to look for, and ignore these colored lines for now, the first thing we need to look for is the arrow. The arrow tells us the direction of the trade, and if the trade is valid, it tells us where our stop loss should be as well. Because it's outside of this band, step one tells us that we're looking at a high energy trade, an explosive trade. There's a couple of different ways to name them. I like explosive because it gets the job across. Normally you're seeing fast movements, which is exactly what you see in this case. So that's step one. We've identified the type of trade. Step two is checking these vector average lines. These change from green to red, indicating short-term momentum change. We want them to be in the same direction as ours. That's step two. Here we can see that red, we're shorting. It's the perfect match. Step three, we need the candle position, open or close, to be below the black line. This is called P1. In this case, it's not. It is above it is below the upper PE, but it's the bottom PE we're considering because we're looking at a sell trade. We consider the sell side of the market. So we don't actually get an entry on the first step. We go to the next candle and we do get an entry. Okay, we start above, but we close the candle below the black PE. Vector averages are still correct, which means that we tick the box for step three. We just need to quickly check step four and step five. Now, step four is the R ratio. It tells us if the market is wide enough to trade. On the top left here, you can see the R ratio. It's green, it's 95.31, means perfectly fine. Now, step five, we consider the trend. For this particular type of trade outside the band, there actually isn't a step five. We can trade with or against, but it's nice to look for it. In this case, we would be trading against the trend, but you'll generally find that's the case on these more explosive movements because the market needs to be stretched beforehand. So it's normally would have gone the other way, essentially. So we get our entry. I have three colored lines here to make what I'm talking about a little bit clearer. Our stop loss is given by the red line. We drag that to the arrow at the point of entry, so in line with this. We then have the green line. I'm going to use the green line to indicate our entry point onto the market. So it's this level, 47864.64, give or take the pennies. And I'm going to use the purple line to track two different things. Now, first of all, we have the movement from just following this trade in the most passive way possible, putting no thought in, just letting the trade naturally close itself out. In which case, you still get a decent return, but you do miss a lot of the opportunity generated by the system. You're getting the best part of about 37 pips worth of movements out of that trade. However, there's a lot more potential we can take. The market actually moved, and I'm going to nick the red line for this just to make things confusing. The total movement on this market, we've gone from 864 down to 725, which quick mental maths, it's 139 pips worth of movement. So there's 139 pips compared to about 30 or 40 pips, whatever I said a moment ago. It also takes less time. The difference between this automatic exit and this best exit is something that we teach in our live sessions as part of the coaching that comes with the course. I will say nobody will ever time the perfect exit, but just look at this chart. It's relatively easy to lock in your profit as you go, and maybe you don't take the whole full 139. Maybe you take out 100, maybe you take out 80, but you can certainly do better than the pips given by kind of like the initial black arrow. To put this into context, 139, let's call it 100 because you never take the full move. 100 pips, pound per pip, is 100 quid in the best part of about 15 minutes. £2 per pip, £200. You can do this all day. I wouldn't necessarily recommend it, but there are really kind of two time slots we look at. For the US markets, we look at the afternoon and the evening. We do about 4 hours worth of live trading for our clients who are part of the system. If you fancy seeing this live traded, we'll go through every single step, all of the extra considerations, and talk about the markets in general. We have the live session coming up tonight at 7 o'clock. There'll be a form around this video Click and watch, ask as many questions as you like, and hopefully I'll see you in there soon. Bye bye for now.